Hey there, it's Melissa with Atlas CFO. Thanks for joining me today. Today we're talking about why accurate financial reporting is the key to the growth of your company. We have learned a few things in our almost 30 years of doing construction accounting and working with contractors, and this one is something I don't know that I've really dealt with, which is why do we need financial reporting to be accurate? So I've got our accounting process up on the screen here. You've seen this before. You have transactions that are getting entered usually daily. You have reconciliations, which is when you reconcile the financial statements, including the WIP, then financial statements, then strategy. You can't skip a step. And if you skip a step, you will end up with either inaccurate or not usable information, or you will make the wrong decisions. So today we're talking about the missing step of reconciliations. When we see inaccurate or incomplete financial statements, it is typically because the reconciliation process, that number 2 step, has not been completed or has not been completed fully. Maybe the bank rec was done, but none of the other accounts on the balance sheet were reconciled, and the income statement, profit and loss really wasn't reviewed at all. Then we are producing financial statements. So just to remind you, we skipped a step and we produce financial statements, and then we make decisions using those financial statements. So when does this happen? Because sometimes people will be like, well, it was fine. It was fine for a long time. One of the biggest indicators is growth. If you are a smaller contractor, many times you can get by without doing this reconciliation process. We see that once contractors hit around $5 million in revenue, it could be $3 million depending on your company, it could be $7 million, it becomes a problem. And the biggest issue is that you now have enough volume that by missing this step, you could be missing critical information that affects your cash flow, it affects your profitability, and so this is kind of like you're ready for it. That's one reason why it happens. The second reason why we see it happening is because, well, construction accounting is weird, and your accountant may not be familiar with percent complete accounting, so that's another piece. And finally, the transactions are getting in. So your payroll is in, your accounts payable, everything is up to date, but it's maybe not in the right spot. And so we haven't reviewed the full set of financial statements to make sure that everything is in the right spot, everything is reconciled, or you could be missing some major entries that need to be made. And that typically happens during the reconciliation process before you hit print on financials. So you don't ever want to hit print button on financials until you've done the full reconciliation, your WIP reporting, and looked at everything in the accounting software, the balance sheet, and the income statement to make sure it's right, which is what we're talking about today. What the effect of not having reconciled financial statements does is creates a few common issues that we see. Some of them are actually dangerous. The first one is when overbilling is not recognized. You think you've got cash, but you're just overbilled. So think about that situation where you think you've got a lot of cash, and skip down to say, I'm thinking making money, so I'm going to buy a big piece of equipment. In that situation, and this is just one situation, you are spending your overbillings on equipment instead of what that job is going to need, which means you're going to be spending that money on that job in the future. So it's very dangerous for cash flow to be in an overbilled position and not know it. Just as important is being in an underbilled position and not knowing it. That means that you are basically the bank. You are the bank for the project because you have not billed your cost, and that is going to create a pretty good divot in your cash flow. Not a great place to be, and you want to be able to have the visibility and the accuracy in your financial reporting to identify this early. Once you get in an underbilled position, it usually takes you about 90 days to get out of it and go back into the cash flow. And the last item is you think you're growing. Yes, it's happening, but you're not sure. And so you start adding staff to handle the growth, but you're actually not growing. We have seen this a few times as well. It can be, again, dangerous because you're adding the staff, but you're actually not in the financial position that you think you are in order to add those staff. When you have financial statements that are accurate and complete and timely, then you can help make these decisions with better data so that you're not going into them blind. So how would you know whether you're in this position? So there's a few things you can do. First off is identify how big you are, because that's kind of a good indicator of whether you really need to lean into this. Look at your balance sheet and see if you are showing under over billings. Now, if you've watched a few of our other videos, you know that can go by many names. Could be cost in excess, could be contract to assets for under billings. So it has different names, but that should tie to the WIP. That's just the second step. If you do have the accounts and it does not tie to your WIP, this can give you an indicator that you do not have complete financial statements. The third item is negative balances where there should be positive balances. This is a big one. So if you look through your balance sheet, there should really only be 2 accounts that have a negative balance, and that's accumulated depreciation and draws or distributions in the equity section. If you see other negative balances, those are ones that you can just hit the pause button, see if you've got some accounts that need to be reconciled. The third indicator is you have gross profit that goes up and down each month. One month you make 40%, the next month you make negative 10%. That is an indicator that there's something that needs to be reconciled and there's a missing step. So I'm going to tell you how to fix it. You need to reconcile all the accounts on your balance sheet. Yes, it sounds daunting, and sometimes it is, but your balance sheet is the key to making the financial statements work. You're going to need to adopt percent complete accounting. This is critical to understanding whether you have timing differences, and that's why you have extra cash or no cash, or whether you have a gross profit problem. Then you need to create a system for financial reporting each month. This needs to be rinse and repeat. Every single month you follow the same process so that every month you know that you have accurate financial statements. And then you can analyze your financial statements and understand what they mean. You can see that a lot of people are skipping to the bottom, and we're going to look at our financial statements. We can't do that until we've done all these other things to make sure that we have accurate data. Analyzing your financial statements is a whole nother topic. We've done a lot of different discussions on analyzing your financial statements, but we're not going to get into that today. We're just talking about how to identify it and how to fix it. So once you've got your financial statements reconciled, and they are complete, and they are accurate, now you can identify the cash flow trends. Now you can identify the gross profit trends. Now you can look at the key ratios to watch. You can satisfy all your banking and bonding requirements, and you know that you're growing profitably. Without these steps, this reconciliation process, making sure that everything is in and proper and right and the right time, you can make decisions based on your financial statements that will ultimately give you trouble. You can't do key ratios if you haven't done the full reconciliation and have financial statements, because analysis comes after financial statements and into that strategy. So you can see how incredibly important it is to follow all of the steps. Okay, so if you like this, you'll like our 7-day financial boot camp. There's a link in the notes. It takes you through 7 emails of topics that you want to dive into. We talk about the importance of construction accounting in the 7-day boot camp. It's free. You're welcome to it. We also have a financial statement rebuild intensive. Whenever I say intensive, I mean intensive. It is the intent to put the contractors back on track on their financial statements. You can learn more about that on our website. We do have limited offerings for this because it is so intensive, and we want to make sure that we give the care that we need to for our clients. Thank you so much for spending time with me today. I can't wait to see you again. Have a great week.